The timeline for how this plays out depends on variables that remain uncertain. If Chinese buying accelerates from current levels, registered COMEX inventories could approach critically low levels within 3 to 6 months, forcing crisis decisions about how to handle delivery requests that cannot be fulfilled. If Chinese buying merely continues at present rates rather than accelerating, the timeline extends to 12 to 18 months before inventories reach crisis levels. If Western governments intervene through export controls, strategic reserve releases, or emergency regulations limiting physical deliveries, the timeline becomes unpredictable and depends on political decisions rather than market forces. The only certainty is that the current trajectory is unsustainable. Something must change, either in the form of dramatically higher prices, collapsing demand, surging supply, or market structure breakdown. Betting that the system muddles through indefinitely while inventories drain and the price gap widens requires more optimism than the evidence supports. The draining of Western vaults to feed Eastern demand represents one of the largest wealth transfers in commodity market history unfolding in real time, while most market participants remain oblivious. Chinese entities are acquiring physical silver at what will likely be recognized in hindsight as historically cheap prices, building strategic reserves that will prove invaluable when global shortages become undeniable. Western holders are liquidating inventory for paper currency that loses purchasing power daily, trading tangible assets for financial claims whose real value depends entirely on central bank credibility and government solvency. The intelligence and foresight lie clearly on the eastern side of this transaction. When the vaults are empty and the paper claims collide with physical reality, the nations and entities that secured physical possession will hold all the leverage while those holding paper promises discover the difference between financial wealth and real assets. The $103 price in Shanghai is not a temporary anomaly or irrational premium. It is the market beginning to price the true value of a scarce industrial and monetary metal in a world that has awakened too late to the supply crisis it faces. The $103 Shanghai price may actually represent a conservative assessment of where global prices need to reach to balance supply and demand. Current Chinese buying occurs against a backdrop where Western vaults still contain some inventory and where Western industrial consumers have not yet fully reacted to the developing shortage. If Western companies begin their own strategic stockpiling, competing with Chinese buyers for the same constrained supply, the price required to ration available metal could reach substantially higher levels. Some analysts examining supply-demand fundamentals suggest that silver at $150 to $200 per ounce may ultimately prove necessary to either destroy enough demand or incentivize enough new supply to establish equilibrium. These projections sound extreme to observers accustomed to silver trading in the $20 to $30 range, but they reflect straightforward mathematics about consumption rates, production capacity, and inventory drawdown timelines. The derivative market structure that enabled silver price suppression for years now becomes the mechanism through which prices must eventually spike to clear the market. Major financial institutions that sold short contracts promising to deliver silver at $70 face unlimited losses as prices rise to $100 or beyond. These institutions must either deliver physical metal they do not possess, driving them into spot markets as desperate buyers, or default on contracts, triggering the systemic crisis the Federal Reserve seeks to prevent. The Fed's liquidity injections buy time but cannot prevent the ultimate reckoning where paper claims collide with physical limitations. When that collision occurs, prices spike rapidly as the paper market discovers that all the trading volume and liquidity in derivative markets cannot conjure physical metal into existence. This is not speculation about possible future scenarios, but rather observation about mathematical certainties playing out in slow motion as registered inventories decline and Chinese buying persists. Investment positioning for this environment requires distinguishing between paper claims and physical possession. Silver futures contracts, mining company stocks, and silver ETFs all provide exposure to silver prices, but with different risk characteristics during a physical shortage. Futures contracts face counterparty risk if exchanges declare force majeure or impose cash settlement rather than physical delivery. Mining stocks provide leveraged exposure to prices, but also carry operational risks, management execution concerns, and equity market correlations that may prove unhelpful during systemic stress. ETFs backed by allocated physical silver offer better protection, but investors must scrutinize the fund structure to understand whether redemption rights are secure and whether the custodian actually holds the claimed metal in segregated storage. Physical ownership through coins, bars, or allocated storage at reputable dealers provides the most direct exposure without counterparty dependencies, though storage costs, insurance, and illiquidity create their own challenges. Western industrial consumers face a mirror image of this strategic vulnerability. As silver flows east and inventories in Western vaults decline, companies dependent on silver inputs for manufacturing discover that their supply chains have become precarious. A European electronics manufacturer that previously ordered silver on just-in-time basis with confidence in prompt delivery now faces extended lead times, supply allocation, and competition from Chinese buyers willing to pay premiums. The manufacturer's choice becomes accepting higher costs and uncertain availability or redesigning products to eliminate or reduce silver content, a process requiring years of engineering work and capital investment. Neither option is attractive, but delay makes both options more painful. Smart corporate planners recognize this dynamic and have already begun strategic inventory building and long-term supply contract negotiations. But many remain in denial that a persistent shortage is developing rather than a temporary price spike. The implications for inflation and central bank policy create additional layers of complexity. Silver, while a relatively small market in absolute terms compared to oil or other major commodities, serves as a critical input across enough industries that price increases transmit throughout the economy. When silver prices triple, the cost increases appear in solar panel prices, electronics prices, medical device costs, and countless other products. Central banks attempting to control inflation through interest rate policy find that these supply-driven price increases prove unresponsive to demand-side interventions. Raising interest rates to slow economic activity does not increase silver mine production or reduce industrial silver consumption in the short term. The resulting cost-push inflation undermines central bank credibility and complicates policy responses. The Federal Reserve faces the uncomfortable reality that their tools may prove ineffective against commodity-driven inflation caused by physical shortages rather than excess demand. Currency implications extend beyond inflation to fundamental questions about monetary stability. Silver has served as money for thousands of years across virtually every major civilization. While modern fiat currencies have displaced precious metals from daily transactions, silver and gold retain their monetary character in collective consciousness and flight to safety behavior during crises. When silver prices rise dramatically against fiat currencies, it signals declining purchasing power of those currencies. A dollar that could purchase 1/20th of an ounce at $50 per ounce now buys less than 1/70th at $70, representing a 40% decline in the dollar's silver purchasing power in just 2 years. If Shanghai prices of $103 represent where global prices eventually settle, that decline accelerates to nearly 60%. Such dramatic losses in purchasing power against a monetary metal undermine confidence in currency stability and potentially trigger broader shifts toward hard assets. Developing new primary silver mines requires 7 to 15 years from initial discovery through exploration, permitting, construction, and commissioning. Even aggressive investment today would not produce meaningful new supply until the 2030s. The permitting process alone often consumes 3 to 7 years as mining companies navigate environmental reviews, community consultations, and regulatory approvals that have become increasingly stringent in most jurisdictions. Capital costs for developing mines at remote locations with complex ore bodies can reach billions of dollars, requiring sustained high prices to justify investment. Companies that might consider such investments remain cautious because they remember previous commodity cycles where prices spiked temporarily before collapsing, stranding expensive projects. The resulting underinvestment during the commodity bear market of 2011-2020 now manifests as inadequate supply precisely when demand has surged. Recycling provides some supply relief but faces fundamental limitations. Silver used in jewelry, silverware, and some industrial applications can be recovered when prices justify the effort. However, modern industrial applications increasingly involve silver in forms that are consumed or so finely dispersed that recovery becomes economically impractical. The silver in a smartphone circuit board, perhaps 1/10th of an ounce, costs more to extract than its market value even at current elevated prices. The labor required to disassemble the device, separate components, and process them through chemical or thermal recovery methods exceeds the value of the recovered silver. Large-scale electronic waste recycling operations recover some silver through bulk processing, but recapture rates remain below 50% of the silver content in processed devices. As industrial demand shifts increasingly toward these dispersed, difficult-to-recover applications, recycling becomes progressively less effective at returning metal to available supply. The geographic concentration of both supply and demand adds geopolitical complexity to the physical shortage. Mexico produces approximately 180 million ounces annually, making it the world's largest silver-producing nation. Peru ranks second with roughly 90 million ounces, followed by China at 35 million ounces. However, China consumes far more than it produces, creating a structural import dependence that government planners view as strategic vulnerability. The aggressive physical accumulation strategy aims to reduce this vulnerability by building domestic reserves sufficient at a buffer against potential supply disruptions. If geopolitical tensions between China and Western nations intensify, the ability to cut off Chinese access to South American or North American silver production becomes a potential economic weapon. Chinese planners, aware of this vulnerability, logically seek to acquire and store multiple years of consumption requirements before such scenarios develop. The draining of Western vaults represents the visible manifestation of this asymmetry. Each delivery out of COMEX warehouses reduces the physical backing for remaining paper contracts. Each shipment to Shanghai removes metal from the pool available to satisfy Western industrial demand or future delivery requests. The process feeds on itself because as registered inventories decline, market participants who previously held paper claims begin questioning whether those claims will remain deliverable. This triggers additional delivery requests as holders seek to convert paper to physical possession before inventories are exhausted entirely. The surge in delivery requests further drains inventories, validating the concerns that triggered the deliveries in the first place. This is the classic dynamics of a bank run, but occurring in commodity markets rather than banking deposits. Once confidence erodes that paper claims equal physical possession, the race to convert claims into metal accelerates until either inventories are exhausted or prices rise enough to discourage delivery demands. The Federal Reserve's recent emergency liquidity injection, discussed in previous analyses, represents official recognition that this dynamic threatens systemic stability. The $3 billion injection aimed to provide financial institutions holding large, short silver positions with the liquidity needed to meet margin requirements as prices rose and delivery pressures intensified. Without that support, these institutions faced potential default on derivative contracts, which would cascade through the interconnected financial system. The Fed stepped in to prevent cascading failures, but the intervention treats symptoms rather than causes. The fundamental problem remains that physical supply cannot satisfy the combination of industrial demand and investment demand at prices anywhere near current levels. The Fed can provide unlimited liquidity to financial institutions, but it cannot create physical silver that does not exist. Each $1 billion of liquidity support enables the system to limp forward another few weeks, but eventually the mathematics overwhelm the interventions. Mining production offers no near-term solution to the supply deficit. Global silver mine output peaked in 2015 at approximately 900 million ounces annually, and has since declined to roughly 830 million ounces despite rising prices that theoretically should incentivize increased production. This decline reflects ore grade deterioration, as high-grade deposits are exhausted and miners process lower-grade resources. Extracting the same amount of silver from ore containing half the concentration requires processing twice as much rock, consuming substantially more energy, and incurring higher costs that rise faster than prices. Additionally, approximately 70% of silver production comes as a byproduct of mining zinc, lead, copper, or gold. Decisions about whether to operate these mines depend primarily on the economics of the primary metal rather than silver prices. A zinc mine producing silver as a byproduct will not increase silver output simply because silver prices double if zinc prices do not justify expanded operations. The $103 Shanghai price represents not irrational exuberance or temporary shortage, but rather Chinese buyers' assessment of true scarcity value once Western inventories are exhausted. Consider what that price signals about Chinese strategic calculations. At $103 per ounce, silver remains cheaper than the future costs of not having adequate supplies for industrial applications that cannot function without it. Solar panel manufacturing, which consumed approximately 170 million ounces of silver globally in the most recent year, depends on silver's unmatched electrical conductivity and durability. China dominates global solar manufacturing with over 80% market share, and the Chinese government has mandated aggressive solar installation targets as part of its emissions reduction and energy security strategy. Without silver, those solar panels cannot be manufactured at scale. Chinese industrial planners have evidently concluded that paying $103 per ounce today remains vastly preferable to facing supply disruptions tomorrow when the metal simply becomes unavailable at any price. This calculation extends beyond solar applications. Electric vehicles require substantially more silver than conventional cars due to increased electrical systems, with high-end models consuming up to 3 ounces per vehicle. China has positioned itself as the global leader in EV production, and strategic planners recognize that silver shortages could constrain that leadership. 5G telecommunications infrastructure, where China has also pursued global dominance, requires silver in antennas, base stations, and countless connection points. Medical devices, water purification systems, and advanced electronics all depend on silver's unique antimicrobial and conductive properties. From the Chinese government's perspective, these are not optional consumer preferences, but rather strategic national priorities that justify aggressive procurement of critical inputs, regardless of current price levels. The $103 Shanghai price reflects what China is willing to pay to ensure these priorities remain achievable. Western market participants, trained to think in terms of quarterly earnings reports and annual budget cycles, struggle to comprehend planning horizons measured in decades and strategic objectives that transcend profit maximization. A Chinese state-owned enterprise directed to acquire 10,000 tons of silver over 5 years will execute that directive methodically, regardless of whether the metal costs $75 or $125 per ounce. The nominal price matters far less than securing the total quantity required. This creates an asymmetry in market behavior, where Western sellers attempt to optimize timing to maximize profits, while Chinese buyers focus on accumulation regardless of short-term price fluctuations. In a battle between profit-maximizing traders with quarterly performance reviews and state-directed entities with multi-decade mandates and unlimited financing, the outcome is foreordained. The Chinese buyers will acquire what they target, and prices will rise to whatever level is necessary to pry loose the required quantities from increasingly reluctant sellers. The mechanics of how silver travels from New York to Shanghai illuminate why the price gap persists, despite creating apparent arbitrage opportunities. A trading firm observing $74 silver in New York and $103 silver in Shanghai might calculate a $29 per ounce gross profit opportunity. The firm purchases COMEX futures contracts, takes physical delivery of silver from registered warehouse stocks, and arranges shipment to Shanghai for sale at the premium price. However, the execution proves far more complex than this simple calculation suggests. Physical delivery from COMEX warehouses requires posting margin, meeting strict specifications for bar weight and purity, and coordinating logistics with approved warehouses. Transportation via container ship requires 30 to 40 days of transit time, during which prices in both markets can move dramatically. Chinese import duties on silver currently stand at 17% of declared value, immediately consuming approximately $13 of the apparent $29 arbitrage opportunity. Currency hedging to lock in the yuan-dollar exchange rate adds costs and may prove impossible if forward currency markets widen their spreads during volatile periods. Most significantly, the arbitrage requires actual physical metal to exist in registered COMEX inventories available for delivery. This is where the mathematics become problematic. Total COMEX silver warehouse stocks, combining both registered and eligible categories, stood at approximately 340 million ounces as of the most recent reporting. However, registered inventory, the category available for delivery against futures contracts, has declined to just 68 million ounces. Open interest in COMEX silver futures represents claims on roughly 850 million ounces. If even 10% of contract holders demanded physical delivery rather than rolling positions forward or cash settling, the exchange could not fulfill those requests with available registered inventory. The system depends fundamentally on most participants never taking delivery, treating futures contracts as purely financial instruments for hedging or speculation rather than mechanisms for acquiring physical commodities. China's systematic physical buying strategy threatens this assumption. Chinese state-owned enterprises, operating under government directives to secure strategic commodity reserves, have shifted from passive holders of paper claims to aggressive demanders of physical delivery. When a Chinese entity purchases a COMEX futures contract and declares intention to take delivery, it forces metal out of registered inventories and into the possession of an actor who has no intention of returning that metal to Western markets. This is not temporary movement of inventory that will flow back when price relationships normalize. This is permanent extraction. Each million ounces delivered into Chinese hands represents million ounces no longer available to back the remaining paper contracts, tightening the squeeze on the entire derivative structure. The declining registered inventories reflect this systematic drainage, as vaults cannot replenish stocks faster than China extracts them. The vault doors at J.P. Morgan's designated silver facility in Delaware opened at 6:47 a.m. on Thursday morning to receive what has become a daily occurrence: armored trucks arriving to withdraw physical silver for immediate transport to coastal shipping terminals. By 9:15 a.m., approximately 2.8 million ounces had been loaded onto vehicles destined for ports in New York and Long Beach, where container ships wait to carry the metal across the Pacific Ocean. This scene repeated itself at facilities operated by Brinks, Delaware Depository, and CNT Depository. By the close of business, Thursday, Western Vaults had released nearly 8 million ounces of registered silver inventory, continuing a pattern that has drained over 120 million ounces from COMEX-approved warehouses in the past 6 months. These are not normal inventory fluctuations reflecting seasonal demand patterns or routine trading activity. This is systematic extraction on a scale that suggests someone views Western silver stockpiles as a strategic resource to be acquired before availability disappears entirely. That someone is China, and the price they are paying in Shanghai tells a story that Western financial media has largely ignored or misunderstood. While COMEX silver futures closed Thursday at $74 per ounce, the Shanghai Futures Exchange settled at the yuan equivalent of $103 per ounce. This $29 premium, a 40% gap between the world Ank's two largest silver markets, has persisted and widened over recent weeks despite every principle of efficient markets, suggesting such differentials should disappear within hours through arbitrage. When identical commodities trade at dramatically different prices in connected global markets, it signals either temporary disruption or structural fracture. The evidence increasingly points toward the latter. The arbitrage that should eliminate this gap requires physical metal flowing from low-price markets to high-price markets, yet that flow is occurring, and the gap widens anyway, suggesting demand in the East exceeds available supply at any price Western vaults will accept. Think of this dynamic like a reservoir system feeding two separate cities through a network of pipes and pumps. For decades, water flowed freely between the reservoirs, keeping levels roughly equal. Price differences that emerged were small and temporary, quickly corrected by opening valves and allowing water to flow from surplus areas to deficit areas. Now imagine one city's population suddenly doubles while its local water sources dry up. That city begins desperately pumping water from the shared reservoir system. The other city, noticing its reservoir levels dropping, tries to restrict the outflow, but contractual obligations and existing infrastructure allow continued drainage. Eventually, the desperate city offers to pay double the normal rate for water, while the reservoir-owning city realizes too late that its stored resources are being depleted to serve demand it never anticipated and cannot replenish quickly enough. The reservoir levels fall daily despite increasingly frantic efforts to slow the drainage. Western silver vaults are those reservoirs, and Shanghai is the city willing to pay any price to secure supplies.